everybody was carried away and blinded with this entire mid-cap hoopla and mid-cap hullabaloo. I mean, you came on my show and you said, look, mid-cap stocks were expensive. There was froth in small-cap stocks, and it's time to really to relook at a dynamic asset allocation. So appreciate your time. I called you early in the morning. You still, agreed for this interaction. So appreciate that.
Thank you. Thank you.
Saurabh Mukherjea, let's pick it up from where Naren left. There is still a lot of froth in mid and small cap stocks. So Saurabh, what are you telling your clients? Buy the first fall or wait it out. This market will give you better entry points.
Look, I mean, we've been saying for the last 12 months that valuations have not made too much sense in our country. As Naren is saying, even now valuations don't make that much sense. We're only just beginning the fall. Hard to know how far this market will fall, but if large caps fall around 15% and small and mid caps fall around 30%, I think we get to some semblance of sanity on valuations. Leaving aside valuations, our suggestion to clients has always been invest in companies with super fundamentals, great cash flows and high quality management. That needless to say, that remains the ambit mantra, the ambit motto on valuations. As I'm saying, I think 15% further correction in large caps and 30% in small and mid caps, I think, is what we are looking out for. And our specific concern has been financials for the past year, and NBFCs and housing finance companies still remains a big area of concern for us, especially as cost of money in the debt market seems to rise on a weekly basis now.
Messaging sort of from you is that this is not the time to buy the fall, because if you're expecting a 15% fall in large cap, I mean, the mid cap, like you said, could be 30, could be 40, this could be 50%. So you are of the view that this is just the beginning of a ugly patch of sell-off.
Absolutely. So what is clear is that the economy is recovering. The economy has been recovering for the last 3 or 4 months. I think the budget gave another stimulus to the economy. The GST rollbacks through October, November will add further juice to the economy, as will the PSU bank recap. So the economy is recovering. I think the recovery will gather steam. Indeed, there's a global economic recovery which is gathering steam across the world. So in spite of that, I think the stock market is overvalued, and therefore if the market pulls back another 15%, I think the opportunities to buy become that much more plentiful. What I certainly wouldn't advocate is to use a day-to-day fall like yesterday or today to suddenly start loading up on stocks. I think that sort of short-term buying doesn't make that much sense. I think be a little bit more patient. Look for openings in high quality sectors such as IT, such as pharma. It was one of the big mysteries for me last year as to why IT and pharma got pounded like the way they did. It's not as if Indian IT and pharma companies suddenly lost all fundamentals. So look for openings in high quality sectors like IT and pharma, where there are frontline names which have historically been successful companies with high ROCs, high cash flows. I think those openings in IT and pharma are still there. We've been supporting buying those sectors in the last 6 months. I think that stays, but generally for the market as a whole, I don't still see value in the market as a whole.
What are the first signs that you'd look out for when you feel that maybe this correction is getting a little abated? Would you look out for signs on what the CBOE VIX is doing, whether the Dow falls a certain number of percentage points more from here? Or would it be when central bankers come out and start talking up markets, try to, soothe the frayed nerves, that maybe easy money will last a little longer than what the markets are fearing?
I think if you ask me, leaving aside the equity market correction, which is a very recent event, I think what has been alarming in the Indian context is the run-up in the 10-year bond yield. That has been almost a rocket-propelled run-up from August, when I think the 10-year GSEC was at 6.3 to now 7.6, 7.7. So I think both globally and in India, we'll look for bond yields to stabilize. This sort of rapid run up in bond yields is worrying, because if the cost of risk-free money goes up so sharply, then obviously you start worrying about money which involves taking risk, which is equity investing. So I think that in the US context, we're hoping to see the 10-year bond yield stabilize. We don't know where it will stabilize. We're not experts on that market. And even in the Indian context, we're hoping that the 10-year bond yield doesn't run up further. If the risk-free rate of return stabilizes, I think that gives you a foundation to work upon. And I think rather than the equity market, we look to the bond market for signs that the equity correction has bottomed out.
Saurabh, in this market, the difference between last big sell-offs we've seen versus is the point which you made, that we are on beginning of an earnings cycle. So do you think somewhere the new profit cycle and the new growth cycle will ensure that the downside may not be large? I mean, stock markets, Saurabh, we both know that they will never be available at their fair value. Either they will overshoot and they will undershoot.
So I think it will, my reckoning is that as signs of an economic recovery take hold, and hopefully they'll be more visible in the Q4 results and in the H1 of next fiscal. I think as signs of a recovery take hold, it will help large caps especially. I'm not so sure about small and mid caps because inflation is back. CPI inflation is above 5%, and I think all the indications are CPI inflation will stay high through FY19. So high inflation is an enemy of small and mid caps because high inflation hurts small and mid cap operating margins. So I think the economic recovery will help large and mid caps both on their earnings and with, I think, some degree of price support. But I think this sort of high inflation climate transfers profitability from small and mid caps to larger companies. So think of a large auto OEM and an auto ancillary supplier. A high inflation climate transfers profitability from the supplier to the OEM. So I think the outlook for larger caps stocks, for Nifty stocks, for BSE 100 stocks certainly looks brighter, both on account of the recovery, economic recovery, and their ability to have pricing power in a high inflation climate. Small and mid caps, you need a steep correction. Even with the recovery, you need a steep correction in small and mid caps for their valuations to make sense.
So Saurabh, being defensive is the strategy, as you're saying, but we've been speaking with a lot of money managers and they say that, don't get lured only by equities. This is the time to allocate your portfolio and diversify. They're saying look at income funds as well, because you've got to keep it balanced in this market. Would that your approach be, that don't invest all of it in one go, even if it is defensives, and don't put all your money in equities right now? How critical is portfolio allocation or asset class diversification right now?
So look, I mean, even if you were to balance your portfolio, which is obviously sage advice, it's sensible advice to balance your portfolio between debt and equity, you do need bond yields to stop running up like this. If bond yields carry on running up and equity markets continue falling, you're getting whacked on both sides. So you do need bond yields to stop running up. If bond yields stop running up, especially using the benchmark 10-year GSEC, then you get protection on your bond portfolio, on your fixed income portfolio, and I think that will also give a lot of support to equity markets. So yes, it does make sense to diversify, but the benefits of diversification will only be felt if you stop seeing this current sort of synchronous movement where bond prices are falling and equity prices are falling. If both fall, then the merits of diversification are somewhat lost for now. I think the other point to note is diversification doesn't just mean across asset classes or indeed just buying sectors like IT and pharma. I think diversification also means buying high quality companies regardless of sector, which are available at sensible valuations. So if you have high quality banks, CASA funded banks with strong CASA franchises trading at 1 times, 1.2 times price to book, I think it's worth looking at those in this juncture. I think on days like this, where you look at Indian NBFCs and HFCs trading at stratospheric valuations, you really got to ask what people are thinking when they buy those NBFCs at 6, 7, 8, 9 times price to book. When you have big bunch of the banking system, a big part of the banking system trading at around 1 times price to book. I think those sorts of trades, the unwinding of those sorts of overvalued trades, I think are also part of this correction.
Saurabh, how much more you think? That's really perhaps the kind of assessment one wants to draw in this sort of a market environment. Typically, we've seen corrections play out, after a really strong run of about 10%, and then the market stabilizes. That's the kind of pain on adjustment the market sees. Do you think that would be the case this time?
I think I'm certainly hoping it will be. I think the fly in the ointment is this LTCG rule, which creates a degree of artificial selling pressure between now and the year end, because people will want to lock in their gains without paying long-term capital gains. So I think the leaving aside the global developments around the US 10-year bond yield going towards 3% and the Dow correcting, leaving that aside, I think this LTCG rule does exert a degree of further pressure on our country between now and the financial year end. So I would say somewhere around 29,000 on the Sensex would be where I would start believing that we've reached some sort of bottom here, and then the market sort of becomes more sensible to buy it. But up to 29,000 on the Sensex, I'm certainly not going to be brave enough to say that the market as a whole is worth buying.
And so, if one were to look at allocating money to equities versus allocating money to bonds, because remember, bonds are cheap at high yields, the trade world over, and that perhaps is also reflected in why US Treasury yields have eased off a bit, because people have started buying bonds. They're so cheap, right? The prices have fallen so much in a rising yield environment. Where would you draw the balance? Park more money in equities, which are high priced, or get into bonds where there is value?
I think short-term government bonds would be one place to park money. I'm not so sure about long-term governments. I'm not an expert on the subject of G-Secs, but I think the sort of run-up we've seen in the 10-year bond yield has been unnerving. So a safe harbor would be short-term government bonds in this sort of climate, and Ambit does have a fund actually which parks money. At least a third of investors' money in that fund is short-term government bonds. I think the other area to look at is gold. The world over, this will be a safe harbor. So mixture of gold and short-term government bonds, and India I think offers now sovereign gold bonds, a mixture of gold and government bonds. So if you can get sovereign gold bonds, I think they offer 2.5–3% yield. You're getting the price appreciation of gold plus some carry. I think those are worth considering as a safe harbor. But the ultimate protection is a well-diversified portfolio, which gives you exposure to high-quality stocks, gold as a commodity which is negatively correlated to equity. Gold and equities, I think, is a minus 70% correlation in India, and some money in short-term government bonds as a buffer for a rainy day. That would be the way to play a troubled scenario. But given the LTCG, it might not be very long before the market correction gives us attractive entry points into the market. I think the LTCG trigger is pretty potent over the next 6–7 weeks.
Saurabh Mukherjea, appreciate your time. Thank you for joining us. Well, Saurabh is of the view that you should not be putting money to work.